This podcast is for informational purposes only and does not constitute legal, tax, investment, financial, or other advice. It is not intended to cause or induce breach of an existing agency agreement.
This is the Victoria Real Estate Podcast. Hello and welcome to the Victoria Real Estate Podcast, where we discuss everything Victoria Real Estate. I'm Adrian Maclaren. I'm joined by my co-host,
Vincent Baart.
And we're realtors on the City Nest team at RE/MAX Camosun, Oak Bay in Victoria. Today's episode is a big one. We are joined by Adam Gant, an entrepreneurial enthusiast with a finely honed interest in housing, finance, and home ownership. Adam, thanks for joining us today.
Thanks for having me, guys. It's great to be on the show and always interested in talking about anything to do with real estate.
Yeah. Awesome.
Now, before we get started, Adam, obviously we're going to talk tons about real estate and housing in Canada, Victoria. Can you give the listeners a little bit of a quick background on who you are and where you came from and your story?
Happy to, yeah. My story with real estate starts in Victoria. I was at UBC, was rowing with the team there at the university, and decided to move to Victoria to train with the national team. This was back in 2002, and happened to buy my first investment property, which closed the day that I moved and set up at the place I was living in Victoria to train with the national team in Elk Lake. So bought a little rental property down in Esquimalt, a townhouse, 2-bedroom townhome, and started renting it out while training with rowing, and that actually kept me quite busy around the training hours, but loved it. Just got into it, found a few more rental properties, fixed them up, rented them out, kept going. And then after rowing wrapped up, just really got into it and started working with shopping centers and all sorts of different kinds of real estate. I had done a couple of condo developments at that point, so really got right into it and did a lot.
Okay. And then, so what was your schooling background when you were at UBC?
Yeah, I was in engineering and was about 2/3 of the way through at that point when I moved to row with the national team. So made the choice to pause and then ended up never looking back and got right into real estate. So didn't end up doing it in engineering. Got into business, got into real estate and kept going from there.
Awesome. So what do you think kind of focus on, I guess, housing finance and affordability? Was it working with rental or these other kind of opportunities? Or
I think personally looking back, interesting question. I've asked myself that at times is where do we find this interest in what we do? I think when I was a teenager, I started having this smoldering curiosity with how does one go and buy a high value property, right? Just like $1 million home or whatever it is.
Okay, so we're not talking like a townhouse. You're saying like larger.
At the time, it was more like, how does somebody do that? Like, how do they get to the point where they can
Right.
go and get one of these amazing properties?
Right.
And I think even going further back, my parents built the home we lived in. My dad did something unique where my mom designed the plan, they bought the lot together, and then my dad hired the carpenter who then he was the understudy to, so he could help him build the home. So he learned about building while building our home with this carpenter.
Wow.
So, evenings and weekends around the job he was doing, he would go back to the site and just work very hard. He's a very hardworking individual. And so I was 3 years old at the time playing around this, growing home under construction, playing with the water hose, trying to help the foundation settle or whatever. And so that was like this flashbulb memory of my parents being really excited to move into this home and me being that young, kind of experiencing that. And that maybe is somehow kept with me all this time. So.
Wow. That makes perfect sense. Now, I'm really curious, like we just glossed over the fact that you went from a relatively modest portfolio at the start. You had this small unit and then you got into these condo projects, shopping centers. For someone who doesn't have a familiarity with real estate investing beyond the mom and pop owning, a basement suite, what does that look like? Like, did you work for a larger company? How did that, I don't know, what's the story there?
Yeah, kind of looking back, it was surprising that it all went the way it did. And I've definitely had, some serious ups and downs with the real estate market, as far as those early days were right when the credit bubble was forming prior to the credit crisis.
Right.
And so the market was just on fire. And that made a lot of things possible. At the time, credit was very easy to get. Right. I can remember being 23 years old and qualifying for 3 rental property mortgages and having a $25,000 unsecured line of credit, things that you'd never see today.
Wow.
And so I was hustling to keep them rented and finish the renovations and doing things, turning them over very quickly. But the kind of financing you can get back then, it's just not available today because of what happened in the credit crisis and the new banking rules in 2011.
Well, and so I keep hearing, I know we'll probably get into all this,
please.
but I keep hearing, because I've done this over the years, I've sat down with people that are 20 years ahead of me, 30 years ahead of me, and I'll say like, okay, like I want to do what you did. How do I do it? And I've heard this theme repeated over and over. Oh, well, back in those days, if you could fog a mirror, you could get a mortgage. And so
it's true.
So it is.
Very true, yeah.
So that was your experience, kind of, you were able to essentially take on a lot of leverage. But Canada, from what I have heard, did not really suffer the same fate as our southern neighbors. So why is it that there was so much banking reform on this side of the border when we didn't really see as much blood in the streets, for lack of a better word, in GFC 1?
So I can give you, in terms of metrics, and this is actually, we can get into this in terms of how it affects housing affordability now and what's driven the value of real estate assets up. But at the time, in the US, especially in the commercial real estate sector, you could borrow a lot more towards the purchase price of a commercial property than you could in Canada. And in the US, they had more options for high ratio financing for residential as well. What we've all heard, the mortgage-backed securities issue. In Canada, our loan to values were lower. So the difference between Canada and the US was, in the US, banks took back and had to own a lot more real estate than they did in Canada. And that put a much greater constraint on banks' ability to lend. And that meant that it took a lot longer to get out of the credit crisis, and it was more severe in the US. Whereas Canada was more conservative. We didn't have banks taking back ownership of real estate as much because our loan to value levels were lower. So we could recover faster and banks could start lending again faster.
Right.
Can we use, I think, an analogy? So can we actually use a specific example? If I was trying to buy, let's say, a $3 million shopping plaza with 3 or 4 tenants today in Canada, how much of a down payment as a percentage would I need? And how much did that change back in the good old days when you were doing this 20 years ago?
So if we're talking about commercial and we're looking at what everybody thinks about when they buy a home, which is loan to value, typically you'll see loans in the, depending on what it is, if it's an apartment building or a shopping center, an office building, 65% or 70% might be more than norm. It's not necessarily based on the loan to value, it's based on the debt service coverage ratio. So what amount of monthly payment can the rent cover? So to use that example at the time, in Canada, you might have gotten a 65% first mortgage for a shopping center, whereas in the US, if you went to the mortgage-backed securities or the mortgage-backed pools to get a loan from, you might get up to 85. And so now in your credit crisis, if your values drop from 100 by 15% or 20% in Canada, the bank's not taking back that property yet because they still have some equity. Whereas in the US, the owner's handing the keys to the bank because they have nothing left in it for them.
Yeah.
And the bank's got to take over the property. And when the bank does that, they now have to set up a whole bunch of reserves on their balance sheet, which constrains their ability to provide new loans.
So for someone listening, one of the expressions we use quite often is if someone is underwater on their mortgage. And so that means you owe the bank more than what the property, if you were to sell it today, you're upside down or you're underwater. And so that's the situation you're talking about. And that's why Canada fared so much better. So how much did it change between 20 years ago and today? Like if I was trying to buy that same commercial space today, it's debt coverage service ratio.
Yeah.
We're working on it. That's the thing that people are really worried about right now. Has that really changed from 20 years ago?
So let's get into this idea of capital reserve at the banks. And I want to introduce some concepts that might be a little bit foreign for most people because they've never run into this, but this drives a lot to do with money supply growth and housing and affordability. So we'll just try to put it together step by step. But if you have a post-credit crisis in 2011, the developed world adopted something called Basel III banking standards. And in those standards required a capital reserve. So the banks had to hold on their balance sheet a certain amount of shareholder equity or equity capital for every loan they made. And each loan got a risk weighting. So a residential home loan was seen as a certain level of risk. A commercial loan is seen as more risk. A government bond is seen as no risk. So if a bank buys a government bond that's guaranteed by the government, there's no risk capital. So this starts to drive from 2011 onwards what happens with mortgage approvals, mortgage qualifications, and the difference between getting a mortgage to buy a home versus an apartment building getting financing to build to rent. And so using your commercial example, everything got harder to finance after the credit crisis because of the reaction to mortgage-backed securities being a dirty word and that not being available anymore. And then also on top of that, banks on their balance sheets had to hold more capital for different kinds of loans depending on their risk weighting.
Got it. Okay. It's not so much that your particular project was riskier. It's that the bank, we think of TD or these, the big five banks having limitless supplies of money, but they don't. And so if they've got, let's say, 100 clients, that there are 100 deals that they're trying to put together, a certain percentage of those deals have to be in safer projects. So they can't be taking on, 100 commercial projects. Maybe 10 of those projects need to be invested in something that's a lot safer.
And the bank will look at, if we have to put $5 of our shareholder equity aside for this home loan, and we have to put $7.50 aside for this commercial loan, how much more interest do we want to get on the commercial loan to make tying up that capital worthwhile?
That makes sense. Yeah.
So, people have this experience, or I've heard of people having this experience at least, going into a bank and having the bank saying, you don't meet our criteria today. Not realizing it's not necessarily their fault. It's the bank's criteria that they happen to set, which changes sometimes monthly. And it could be because the bank is run out of desire to lend on a certain kind of asset because of the capital they have to reserve for that. So they might tell all their branch managers, no more of these loans right now. And so guess what the branch manager says? You don't meet our criteria. And you think it's your fault.
And you think that the bank is never changing. It's something that you did, and you just have to go back and work harder, improve your credit score, all of these things. So if you're saying some of these metrics change every month, is it insane to say I'm going to try and go back to the same lender every quarter and see if I can make a project work?
No. If you can have the particular project sit and wait for you to make the decision. But with the housing market, it's a little bit different because there's always going to be a home of some size, size and price point.
Right.
So preparing yourself to be able to pre-qualify or to become qualified for a home, you can keep trying at that. And it is worth continuing to try because sometimes you'll hit, you'll improve yourself and you'll be at the right place at the right time with that bank who now has money to lend for that loan at that point in time.
So I wonder, if it's better to start this process in January when the banks have a fresh start to the year and they're looking for places to put their money.
I would say, generally speaking, the business cycle will drive it much more. Yes, the annual budgets do have an effect. I just was talking with a credit union the first week of January, and they said, we just can't look at it in January. We'd like to do something. We just can't look at it in January, partially because they're closing other business out, but maybe because they they've got enough in the pipeline. They're just not going to have room to approve anything more.
Right. Interesting. Okay. Sorry, we're going way off.
Yeah.
Adrian, get us back on track here.
Sweating bullets over here. I'm just kidding. Kind of coming back over to housing affordability. Most housing discussions kind of focus on supply, demand, government policy. And one thing that I saw, in your work is that you argue that we largely ignore the cost of financing. Why is that such a blind spot?
I think because it may be a bit more because it's esoteric and it's hard for people to get a handle on, again, why they may or may not qualify for a mortgage at a given point in time, if we're talking about housing. But I think structurally since 2011, there was a change, and it wasn't that apparent until after interest rates started rising in 2022, because rates were so low for so long after the credit crisis that the change between rental and house and owner financing wasn't that profound. But now it's become much more significant, and I can go through this, and it relates back to what we were just talking about, which is capital reserve. Yep. Right now, today, a landlord that is going to build an apartment building can get financing that allows the person living in that apartment paying rent to afford a unit. I'll put it in physical terms rather than financial terms, but afford a unit that's effectively 40% bigger than what they could qualify for a mortgage to buy with the same income because of three factors. So since 2011, banks now have to reserve capital for home loans, and we'll use this roughly 5%, compared to if a landlord goes and gets a CMHC insured mortgage and that Canadian Housing Trust sells government bonds to fund it, the bank can hold those bonds on balance sheet with no risk capital. So it costs the bank more to fund a residential home loan than to fund an apartment loan that is financed with a CMHC insured loan. Okay. So that's one of the three. The second is amortization. A bank can only go up to 30-year amortization on a home loan, whereas an apartment building can be financed with 50-year amortization under the MLI Select program. That makes a big difference in monthly payment and debt service coverage for qualifying. And the third is a stress test. So it costs the bank more to hold the capital to finance a home loan. They can't do as long of an amortization. And the stress test adds additional interest on for qualifying, which reduces the amount of loan that somebody can qualify for, even if they could pay a higher monthly payment.
So the commercial lads trying to get these MLI Select programs together, they don't have the stress test to worry about.
Correct. There's no stress test for an apartment building.
Oh my goodness.
So the wheels are spinning.
So I'm like, I'm in the wrong game over here.
So there is an underwriting qualification with MLI Select, but it doesn't add extra interest on. It uses the bond yield, the spread over the bond yield as the basis for that cost, as opposed to the bank's posted mortgage rate, the competitive mortgage rate. So the banks right now have at least a 1.5%, there's a 1.5% spread or 1.5% more interest cost on a home loan than a CMHC insured apartment loan. Okay. So there's actually a higher funding cost if I want to be a home buyer and go and get a mortgage to buy a home with from the bank than if I go and live in an apartment that is financed with a CMHC insured loan through the Canadian Housing Trust mortgage bond program. So that's a structural difference in the world of financing that is strictly policy driven.
Interesting. So now this change, sorry, I'm just trying to consume all this knowledge. Is it a factor in why we're seeing so many more rental buildings being put up right now?
Because developers just respond to where they can absorb their completed product. If they can't get people to buy the condo because the people can't get mortgages for it, but the people have to get into homes, they move into a rental home, and developers can get the rental home construction finance. They're going to build more rental.
Yeah.
And there's another example too that I heard around GST. So if you're buying a condo, it's not your first time buying a place, you're buying a condo from a developer, you have to pay 5% GST. But if that developer was to, instead of building a 20-unit condo building, build a 20-unit apartment building, and then sell that apartment building off to a REIT, so far as I understand, it's GST free.
No one pays GST.
So there's an instant 5% savings or incentive for a REIT to be purchasing a 20-unit building over top of 20 individuals putting together 20 individual sales.
Yes, absolutely. So
Crazy.
There's 5% of the cost of the value right away in GST. The way the credit cost, the mortgage is buying power. So if you look at, based on my income today, what can I qualify for in a mortgage? The average household income in Victoria right now is around $100,000. But 83% of families have that or less. So it's highly skewed in the sense that
interesting.
Most families have the average or less. The average is not 50%. It's skewed to this much higher percentage of the population. And at the average, families in Victoria can barely get qualified for a $500,000 to $600,000 mortgage based on the stress test, 30-year amortization, and current interest rates. Mm-hmm. But at $100,000 of household income, they can easily afford to make the monthly payment, the rental payment, on an apartment that is worth $1 million using a 50-year amortizing mortgage and the CMHC insured rate with no stress test. So think about the size of that home between a $600,000 condo and $1 million condo. If the finishing quality was the same, you can move into easily a 3-bedroom townhome or condo with $100,000 of family income. You can't get a mortgage to buy that size of unit with the current mortgage financing rates.
Right.
Well, and most landlords, they're not doing a whole lot of stress testing on your income. They'll have their own interest that they'll set, but the government doesn't say to a landlord, "Oh, you must stress test your tenants." It's
not at all.
It's a business decision that the individual landlord or property manager makes to say, "Okay, is this tenant application, is it risky for them if they're putting more than 50% of their income into housing?" Whereas the bank would throw you out on the street if you were trying to borrow the same amount of money.
The landlord's cost of somebody not being able to keep up with rent is much, much smaller than a bank that has to foreclose and go through the court process. It's tens of thousands of dollars if somebody can't make their mortgage payment to have that person move out, whereas with a tenancy, it might be a few $1,000s.
Right. Now, there seems, in my mind, I feel like there maybe would be a hack with this, this information. I build a rental home for Vince and he builds a rental home for me and we're getting cheaper financing.
That's a great idea. You'd make a great landlord.
Thank you. Now, is there anything like that you can think you can kind of use this information to your benefit? Is this more just an unfortunate circumstance in how things are currently set up for people who want to real estate?
Well, so most of the banks have a policy, generally speaking, where an individual can buy up to 4 rental property and still have it fall under the residential financing rates, which is going back to that 5% capital reserve versus the commercial 7.5% capital reserve. And that's just a relative example. So if you were going to buy a rental property, you'd still have to qualify for that as a landlord, and the bank would use your income plus the rent and everything else to qualify for it. I haven't actually seen the example of the math, whether or not it'd be easier to qualify if you rented your own home or you rented your friend's home and you got mortgages for each other's, what each other was renting from each, right? So
get like 16 friends.
Yeah, and all rent to each other. Yeah,
and have 4 fourplexes.
Yeah.
I think
anyway,
it's likely still
it was a silly kind of
the same challenge, right?
Yeah,
Whether
yeah.
you're buying it for yourself or buying it to rent, I think it's probably still similar underwriting challenge. So, yeah.
Now, we already kind of chatted about the 2008, 2009 credit crisis and how that kind of fundamentally changed. What about, and you can touch on that again if you like in this next point, but what about the COVID era? Is there any policy changes, and did that kind of change?
In terms of affordability.
Yeah.
So COVID was, I remember reading this article in The Economist magazine in July of 2020, and it had the picture of the world with this bucket and said free money. In that 3.5 months, Canada had $327 billion deficit between, so March 30th is our fiscal year end for the country, and then reports in March 2021. So during that 12-month period of time, the largest deficit in history, nothing ever comes close to it, $320 plus billion deficit, which was all of the COVID stimulus. So
CERB. Those sorts of things,
everything.
yeah.
So
Okay.
all of anything that part of what revenue that was provided could have been anything in that category that was stimulus spending. So that at the time represented about 17% of Canada's money supply. So in a 3-month period of time, the government of Canada pumped 17% more money supply into the system. And at the time, I think it was a deficit of our gross domestic product. So the massive numbers, right? And the U.S. did something similar.
And we wonder why inflation was totally
took off.
nuts.
Yeah.
Like we just
How did
added
this happen?
17% to our monetary supply out of thin air.
And if you think about that, it's not a hard leap to say, that inflation could have been 17% the next year. Like once
Right.
transaction activity got back to the normal level, velocity of money movement, so people working, doing all that normal stuff, GDP and everything recovered a little more slowly. It wasn't instantaneously, but once everybody got back to work at a normal level, it's not a hard leap to make that inflation went up 17% because of 17% more money in the system, right? So what did COVID do? Well, clearly it did that, and rates dropped down to a very, very low level to stimulate the economy again, get it back going again. And buying power is highly driven by cost of credit, right?
Yeah.
If you give somebody the ability to qualify for a much larger loan and they're going to go and buy a home that is a better home or a bigger home, they're going to do it.
Oh yeah, I had some, really quick COVID anecdote. I remember being out there, in the trenches in 21, and buyers would say, "Oh, we'll just throw an extra 50,000 on the offer." And I said, "Well, I don't actually think we need to do that in order to get this accepted. Like, we're overpriced already. Like, let's just try it." And they're like, "Well, we really want this
don't wanna lose
house.
it.
We don't want to lose it, and that $50,000 costs us $80 a month." And so it's this old anecdote that we've heard decade from the sales veterans that most consumers, they live in their monthly payments. They don't think about the $1 million house. They think about the $4,300 mortgage payment. And so you're bang on. And I think that's confirmed by all of the people that are out there schlepping houses on the front lines. We have these conversations day in and day out with consumers.
I remember talking with a fairly active mortgage broker in town. It was probably mid 2023, late 2023, looking back to that fall of 2021 and thinking, fall 2020, people doing 5 years on their mortgages and what they could afford to buy at that point. And this conversation was, what's going to happen when those 5-year terms come up for renewal? Like the system will effectively break if rates haven't come back down substantially by that point. And guess what? That was the last 4 or 5 months, right? That was fall 2025 when those rates started to turn over again and people had to pay the new rate. And so no wonder, the market slowed down the last little while with rates going up and then coming down much more slowly than we all would have hoped, because people are now facing that renewal cliff that everybody was worried about back in, kind of when rates were starting to go up. So anyway, buying power is a big deal. Like real estate housing values are directly connected to interest rates because of what people can afford to buy. And also, I think there's something that's happening right now, separate from population growth, which is household formation. We don't talk a lot about how many people are living in each household, 2.6, 2.8, whatever the number is.
Yeah.
And I think household formation is stalled right now because of a couple of reasons. One is if rates are falling and people believe that if they wait to buy until the rate stops falling or falls even more, then they'll save some money on their mortgage. The moment they believe that rates are not coming down, they'll say, well, this is the best I can get. Now I should go and buy. And then also, if they think that home values are not rising right away, they'll wait to see if they can get a better deal. But the moment home values start rising, they think, oh, if I wait now, I'll pay more. And so it's almost like this double-edged sword where as soon as rates stop falling and home values start rising and household formation kicks back in, is if you have roommates, they'll both buy a one-bedroom condo each. If you have people living at home with their parents, they go out and buy their first home.
Right.
And that starts this whole ball rolling again where then it starts feeding on itself. The market starts growing, more people get back in because they don't want to miss out, rates stop falling. So I think we haven't hit that point yet where household formation begins again. But I've heard stories in Ontario of, households with 10 people living in them and multiple, bunk beds and things like that, because people are just waiting, or they're not ready to move out and get their own place until they know it's going to go up and the rates have stopped falling.
So for a data nerd listening out there, not us.
Yeah.
For clarity, you mentioned that sort of household formations. Is there a data point that's out there that someone can say, like, it's not interest rates, it's not consumer confidence, but there's this other sort of leading indicator? Is there a data point that's publicly available that a data nerd can look for that as sort of the buying signal to say, okay, we're just coming up the backside of this valley?
The buying signal, and we can kind of look at the result rather than the cause, but the result would be home prices start going up. And that would be like the market speaks, right? The market gives us that overall result.
But there's a lag there. So if I'm looking at the HPI house price index in Victoria, and okay, yeah, we're down 2% over last year, for example, I might say, okay, well, the market's still going down. Those housing formations, when those people start saying, yeah, I'm going to go out and I'm going to start shopping, there's about a 3-month lag from the time that the sales happen. And then from the time the sales happen, there's a reporting lag before we actually start to see prices going up. So I'm trying to say, like, could you get in front of it, say 4 months before we see the HPI go up? Is there a leading indicator that we could be looking for?
Are you asking Adam to predict the future?
I'm looking for a crystal ball, Adam.
Okay, well, we can use this as the transition to what drives housing affordability, because I know you want to get there. But so I would say that there's a couple simple rules of thumb. Obviously, interest rates drive buying power, and then supply and demand is, in terms of market pricing on homes, is the old steady hand as far as what we can rely upon for what's going to drive that growth. So population pressure on housing demand is a big one, and the announcement the government put out in November of 2025 to correct the view on immigration and temporary residence is a big factor in what will drive house prices. I think it's like an ice cube tray with this trickle effect from one city to the other. When you have a bunch of people moving to one city and prices start to go up, people sell there if they can move to a more affordable place, or the city gets full and they have to then move to the next city where there's actually room for them. And typically when people are immigrating to Canada, they end up wanting to go to a place like Vancouver, Montreal, or Toronto.
That's the first stop.
Yeah, or their desired stop. Maybe once they're resident, they have a choice.
Yeah.
But what the government just put out is, and you look back on it now, there was this reckless abandon of temporary resident growth because they had no target. So it was just whoever wanted to come under that one program, and there was over 1 million people extra that came that weren't expected.
Right.
So population growth, we just basically filled up the whole country in a year and a half. There was no more room for that moment in time. Everybody can remember it back in kind of 2023, where you had to put up, in Toronto, I heard stories of people having to put up 6 months worth of rent on deposit to get a rental because that was how competitive it was.
Wow.
And people living, in a 1-bedroom condo with a single bed on either corner of the 1-bedroom and all 4 corners of the living room because they couldn't find any other places to rent.
Yeah.
So that happened then, and then the government then tried to correct for that leading up to the election, and then now with what they announced in November 2025, saying they're going to reduce the total number of temporary residents down to 5% of the current population by the end of 2027. So we basically can't get total population growth between now and once that's done, because the number of temporary residents that have to leave to get to that net number.
Right.
But we will have permanent resident growth because they're constantly letting new permanent residents in. So what that means is, you have to be really careful of what kind of real estate you're expecting that growth to hit. Mm-hmm. So if temporary residents are leaving, would they be moving out of? And if permanent residents are coming, where are they going to want to move into? And where's that buying power and pressure going to be in the market? And you have to be a little bit tactical until we get back to total population growth again, which will be 2028.
Interesting. Okay.
He just gave you the crystal ball.
That's it. But there's an important distinction that you made, and that's, I think, the people that are here temporarily, they're more likely to be, roommates. Like, hey, I'm just here to make as much money as I can, or get through school, or I have a time constraint here, so I'm not going to put down roots. So I would think what I'm hearing here is the smaller rentals are going to keep coming down in price,
depending on new supply, right?
Yes, and new supply is going crazy.
Because we're not necessarily going to have the population shrink dramatically. I don't see the population. I don't see how the population grows in total. Obviously, segments will grow, but keep in mind a lot of permanent residents come from having been a temporary resident. Like over 100,000 people a year turn from a temporary resident into a permanent resident. So they're already here. They're already living in a home here already.
Right. Yeah, that's a good point. So we might look on paper and say, oh, our population's growing, but it's like, well, actually the number of beds needed in Canada hasn't really changed.
Right.
We're just flipping their documentation status over. That's really interesting. So from a population perspective, we're not going to see anything totally crazy for the next couple of years, but we are seeing a huge spike in rental supply. At least you look around Victoria, and I tell all my clients, like every construction crane that you see in Victoria right now, 90% are rentals. There's not a lot of condo projects. They're not handing out they don't have the sales centers with the free lunches anymore for realtors. I miss those days.
iPad draws.
Yeah, that's right. Yeah, if you're a developer out there, we could use a free lunch.
We miss our cards.
That's right.
Yeah.
So I think that's a trend that is going to keep pushing rental prices down. From what I'm hearing, I don't see rents jumping.
Or at least not appreciating as fast, right?
Yeah.
If we're meeting the demand with supply, that should mean a neutral price appreciation effect, right?
So what submarket of housing do you think is to, I guess, appreciate with?
Yeah, who's going to win in the next 3 years?
Well, yeah, like before this 2027, we're kind of already talking about how the rental supply, smaller stuff, maybe that's hitting the flat. What part of the market are we talking? Single family is where we kind of think that there is that potential for appreciation because of the PR changeover, or
people having families.
Yeah.
So I think this is the other dynamic with housing affordability. So we'll get into kind of tie this all together, nice bow, but supply constraint, land supply constraint is one of the problems with housing affordability. So I would boil down housing affordability into really two buckets. And this is the whole picture is monetary supply and inflation, population, land supply. If you have no population growth and you have no inflation, you have no change in housing affordability. When you have population growth and a constrained land supply and inflation, homes will continue to become more and more unaffordable. So in Victoria and BC, we have this thing called the Agricultural Land Reserve, which was created back in 1973. And as you guys know, and as everybody knows, prohibits development on any land that could produce food, even if it doesn't currently grow food, to protect our ability to grow food in the future. And from a development standpoint, all of that land would be the best land to develop because it's flat. It's, it would be cheap to develop on, but guess what? We can't develop that land. And then in BC, in central Okanagan, southern Vancouver Island, and Victoria for sure, and Victoria may be the one most constrained, and in the lower mainland, we have mountains, we have the ocean, we have geographical constraints as well.
Adam, I've heard that from so many people, but I've also heard that over 90% of BC's land mass is Crown land.
And if you call up the Crown office and ask them if we can buy some land for development, they'll say, we're not selling any land to private developers.
So, the government is saying, we have a housing supply issue. It's our number one election issue, housing affordability. We all agree that it would be really nice if there was some cheap land, and the government's sitting there on over 90% of BC's land mass. It's like they're riding a bike and sticking the meme, they stick the stick in and they're falling head over
their own bike, yeah.
on their own bike.
Yeah.
And it's like they're surprised that we have a housing issue. So why not do like even a 99-year lease? Like there's all this land that's, forestry land that's on like fourth growth. They've cut it down 3 or 4 times. Like turn it into a 99-year lease, have some communities pop up, and then you're still protecting the long-term Crown grants. I don't know. It's a thought.
I think that certainly if we can build enough homes, or to put it differently, if we only allow immigration and population growth to the level that we can supply homes for it, right? If we set our immigration targets based on housing starts, what we can actually build homes for, we shouldn't have a problem with supply. However, given current construction costs and inflation, construction costs aren't going down. So to build that new home at the margin, it's still going to be expensive because the people that are going to build it live here and have to get paid to build it.
That's right.
Right.
And so even if we had land available, which we have enough land to do redevelopment, multi-story apartment buildings, not single family.
Like infill projects.
Infill projects, yeah. And to touch on to your prior question, which is what kind of real estate, if you can, could you buy or should you buy? My view is that single family detached homes are more like a fine work of art than something that is tied to family income. If you have the capital to buy one, it can become increasingly rare. And if you look at housing start numbers, they do not show housing demolition numbers. So the current level of housing stock, even though we talk about how many new single-family homes are getting built, we don't show how many you demolish to build that new home.
Yeah.
So the current amount of homes, single-family detached homes, will actually start declining in total.
Yeah, that's what I've been saying.
In Vancouver, it's already happened. Vancouver proper housing stock is down 3,000 single-family homes in the last 10 years, even though they're talking about having 400 new homes get built each year, because they don't show that all those homes are being built on lots where there was already a home and they're just demolishing and building a new one. So in Victoria, we have very few places for single family homes left. Look at Royal Bay, the western edge of West Hills, Bear Mountain. There's no more single family lots. You don't see single family homes getting built at Bear Mountain. You have a bit on Latoria Road on either side, some kind of 10 to 20 lot subdivisions.
Yeah.
But throughout most of Greater Victoria, at best, you'll buy one house, knock it down, and build two. That's it for single-family detached homes. Most of the places we're knocking them down and doing assemblies and building multi-story buildings. So single-family is something that can outpace general home appreciation, especially condos and apartments, because it's going to become increasingly rare.
Yep. And that makes sense. But back to your original point about the cost of borrowing all of this stuff. So even if you can squeak into a home where the family price is $1.2 million, even if you can qualify, you're now paying way more for your housing than you would if you were in a smaller home. And so you're sitting on that piece of art, hoping that nobody else makes any more art and that eventually the art will go up in value. But in the meantime, you're renting, you're paying a high mortgage housing on this art.
That's exactly it. And so it's not going to be because you can afford a mortgage. It's because you inherited some capital from your parents, right, or you bought a long time ago and you just happen to be in the market and it's appreciated. And now you still have that equity to use if you're going to sell that home and buy a new one. It's not because you're going to be able to make the mortgage payment, unfortunately.
Yeah.
They're not going to be affordable.
Yeah.
Adam, one thing I want to make sure we chat about is shared equity.
Yeah.
Yes. Now, you recently discussed shared equity housing on CTV in a interview, and you also co-authored a book. Yeah, named A House Shared. So for listeners unfamiliar with it, what is shared equity and what problem is it trying to solve?
So I see shared equity, and this comes from an experience in Singapore and going and actually walking off the street and talking to their economic staff at the Housing Development Board in Singapore back in 2013, and did some research about how they did what they did. And so if you think about the cost of financing, the cost of debt as it relates to a home, the more you borrow, the more risky it becomes for the lender, the higher rate that they're going to want to charge you for that risk, the less affordable the monthly payment becomes. So if we think we can solve housing affordability with just mortgage financing, I think that's where we got to in 2006. Mm-hmm. You could borrow 100% of the price of a home. It didn't really move home ownership that much. It maybe moved the needle by 1% or 2%. So debt is part of the answer, but maybe it's only about 2/3 of the answer, which is about where we are today for home ownership. Mm-hmm. So what's missing is an organized source of equity financing. Because if you add equity, reduce the level of debt, you can get the monthly payment down to a level where it's actually affordable, because you're doing two things. You're reducing the amount of debt and you're reducing the risk of that debt, so you can get it down to a lower rate. And if you add equity in and now give people a chance to share in the equity growth, you can get them started with a lower down payment and effectively a lower monthly payment or a more affordable monthly payment.
Right.
So there's actually two sides to it. One is the down payment piece, but then there's where does the debt come from? So going back to what we were talking about earlier, where if the banks have this capital reserve for regular home mortgages, but if we go and get CMHC insured financing, it's a government bond driven program, it's lower cost. Well, why not have organized housing funds get that financing, pass through that rate to the person living in the home, and give them a share of the equity growth? So we solve both sides, the mortgage side and the down payment side.
Right.
So shared equity is a concept that is meant to give families a springboard to build equity faster than if they just saved on their own. But if it's organized in the right way by a housing fund that can get access to this government insured financing, it can also pass through a much lower monthly payment too, not just a down payment solution.
But
Right.
Canada tried that. They had
As a government, yeah.
as a government.
Yeah.
And from what I talked to with a lot of mortgage brokers, there was not a lot of uptake on that because there was this weird queasiness about becoming a property owner with the federal government as a
partner.
As a partner,
Yeah.
people are like,
Yeah.
that's not want to be, getting into business with.
I find that really curious. So Stephen Polaz, who was the past governor of the Bank of Canada, up until basically, I think it was June of 2020, right after the kind of major stimulus event with COVID. That was when his term came up. He was one of the driving forces behind that program, that shared equity program. So kind of interesting that it was stimulated that way. And I'm not exactly sure why it didn't take off, other than exactly that point, is people didn't totally feel comfortable with the government for whatever reason being their partner. Mm-hmm. And so I guess the question is, would people feel more comfortable with a company that has a reputation at risk, or multiple companies to choose from, and they compete for the business of the of the resident based on how other residents say they like them. It's kind of like that Airbnb, you rate the host rates the guest kind of reputation system.
More transparency.
Yeah, or just, when you know that your reputation's out there as a guest, you want to make sure that the host ranks you well, and vice versa as the host, because other people are going to see it and your business depends upon it, versus a government where their policies change with the wind or with the term of the leadership, right? So I think that's a factor. And we'll see if that plays out that way.
There is currently shared equity programs. Like, doesn't Langford currently have?
Oh, that's right. Good one.
They have one, right?
And
Are you aware of
AHOP with
that,
BC
Adam?
Housing.
I actually helped get the Langford idea going.
There we go.
It was so Calgary has their Attainable Homes program, and Langford looked at that as an option. It's tricky so a municipality can offer a grant. CMHC no longer allows a mortgage charge behind an insured first mortgage. So the challenge is going back to the exact same issue that home buyers, if they're not using shared equity, affects those that could use shared equity. If the municipality is providing a grant, the buyer still has to get qualified for the mortgage. So with the stress test, the city has to set an income cap to keep it fair. The income cap ends up being too low to qualify for the mortgage on the home that they would actually live in.
So these people are just kind of falling through the cracks on either side.
It's just a challenge.
Yeah. And then what about, there's also a couple condo in Victoria, or maybe elsewhere that maybe I'm not aware of, where they partnered with BC Housing and they're doing the 10% down.
Yeah, AHOP.
Yeah, AHOP mortgages.
Yeah.
So is that also kind of another
I'm a big fan of all these different kinds of innovations, developers doing things, BC Housing. A lot of times we focus so much on affordability and making sure families can afford a home comfortably. But I believe strongly in also helping them build up equity. So not just is it an affordable monthly payment, which is critical too, but not just looking at subsidized rental as the only way to satisfy affordable housing.
Yeah.
Right. Okay. Now, who do you think would benefit from shared equity the most? Is it just for first-time home buyers, or does it kind of have a broader application?
So I think in anything, it's hard to look at a universal solution because it's a stratified market, right? Yeah. Different size families, different amounts of income, different locations, what's available in the place where they want to live. And so if you look at kind of income demographics and go all the way up and down the scale, they have different tranches or different solutions for each level of the market out there. So a single parent household versus a family of 5, there's different solutions needed for each tranche. I think the idea with shared equity, if offered with an affordable monthly payment, is to help anybody who's maybe could have been a home buyer in 5 years or in 8 years go and get there faster.
Right.
Or somebody that is not quite able to get going building enough equity so that for them it might take them 15 years. And by that point, home values have appreciated away from them. And now get them
harder. You're
now.
Chasing them, right?
Yeah.
I get what you're saying.
And I think the math of shared equity is if the share is right, the faster the market appreciates, the somebody can get to a conventional down payment. So it actually flips that issue on its head, where now if the market appreciates, they're protected in a sense because they're getting part of that growth.
Yeah.
Versus not having a share and having to try to keep up with that growth, saving faster and faster as the homes appreciate. And we're not talking about real appreciation. We've seen home values grow from inflation and from market appreciation faster than family household incomes over the last 50 years.
Absolutely. Yeah, that's I think the number one complaint that I hear from and younger is, the back in the parents' day, the boomers' day, you could afford one income. It's outpaced wage growth. By a long stretch is housing unaffordability. Yeah.
And here's a kind of a shocking comparison, because I know a lot of baby boomers talk about how hard it was in 1982 when interest rates were at 21% or 18% or whatever, whatever the mortgages were. Going back a year and a half or so, we did a comparison between current interest rates and current median family incomes and house prices and 1982. And at that time, the monthly payment was twice as expensive as 21% in 1982 for that same family and that same size home. So in other words, baby boomers had it easy at 21% compared to what families are dealing with today.
Because they had a $100,000 mortgage instead of a $900,000 mortgage. Yeah.
Relative. So in other words, family incomes have not kept pace with that average single family detached home price. So the size of home and the amount of your income you had to put towards your mortgage payment was half 21% in 1982 to what you would pay now from your income.
Right. So when my parents say, hey, I had a 21% mortgage, look how good you got it.
Yeah, you could say, I would have loved to have that. If I could get that today, I would take it all day long at a house price. That was the price it was in 1982, right?
Awesome. I want to transition back over kind of to market outlook and kind of forecasting. We already a little bit kind of talked about how we think, especially in Victoria, especially single family is potentially a depreciation, or there's a limiting asset.
It's limited. It's going to go up in value slowly,
Yes, exactly.
like fine art.
Yeah, like fine art. Do you have an outlook for single family home appreciation across BC, like Victoria, Vancouver, Fraser Valley, all similar stories, or is there any differences in each of those markets?
Don't loop us in with the Fraser Valley. Come on.
So I actually think that homes can double in price again. Single-family detached homes can double in price again.
Oh, I've been saying that too. Okay, nice.
In the not too distant future. So the reason why is if you look at the owners of homes and where they have their capital and the status that comes with owning a single-family detached home, like I said, people don't own homes because they are worried about the mortgage payment. They own homes because it's perceived as better to own a single-family detached home than to own a condo. We all would prefer to own a home with no mortgage payment if we could, if we had the capital to do it.
Mm-hmm.
So it's going to become more rare. The source of where you fund owning that home from is going to come from your net worth. Well, that's going to grow with monetary supply growth and the stock market value growth. So places like Victoria that are seen as having enduring value, we have the rain shadow, we have the mild climate, we have the nice weather, not too hot, not too cold. People are always going to want to live here. And if they're going to live here, if they have the capital, they'll want to live in the best place they can.
Yep.
So if the stock market keeps growing at 6 to 8% per year and monetary supply grows at 5% a year, homes could keep growing at 3 to 5% per year. There's no reason why not.
And it's not related to income, it's related to wealth.
It's related to wealth,
Yeah,
and
that makes
desirability.
perfect sense.
So I think, like fine art, in this case, you actually utility from living in it in a nice home. An average house price of 1.2 million could be 2.5 million in the not too distant future, which sounds insane.
Yeah.
But if you go to Hong Kong and you see the value of homes there, like $10 million is kind of a normal house in Hong Kong. There's one condo building up on the hillside that sells for $100,000 a square foot.
Is that the one with the giant hole in the side of it?
There's a slight spiral. Anyway,
Okay, yeah.
But again, I'm just using that as places where it's much more expensive than where it is here, and to understand that it can keep going up, right? The value, the monetary
Yeah.
supply and the value of the stock market can keep growing. There's no reason to stop anytime soon.
Yeah. And Adam, when you look at Victoria as sort of a blue chip stock, it becomes the of wealth. So you have everyone across Canada working, building wealth, and they have the wealth to retire and cash out and get as close to Hawaii as they can. They move here. So that makes sense.
And they have to compete with each other.
And they
right?
have to compete. So you're not just competing against your neighbor in Victoria that you grew up with. You're competing with every person who's retiring or cashing out from their businesses across Canada. And then the other thing that you mentioned is the price of housing in Hong Kong or the price of housing in New York or London. You have a lot of these places that are world-class cities. And I wouldn't say Victoria, okay, I'll say it. Victoria is a world-class city. But it's so desirable. Most growing up in New York would never say, oh, it's my right to be able to buy a condo. They'd say no, like if I'm really lucky or the stock market does really well, I might be able to get into it. And I think that's the shift that is happening in Victoria as we move towards this idea of actually owning a home in Victoria is not a right, in the same way that it's not a right in London, England. If you wanted to own New York, if you wanted to own a home in New York, you might have to drive 45 minutes out of the city and then you can buy a house. And it's kind of the same here. We have amazing deals in Duncan, which is 50 minutes away. But to actually be in the middle of it all in Victoria, it might actually not be affordable for the average family. And it might not actually be fair to say that it needs to be affordable for every single family in Victoria to own real estate, because we're not competing with each other. We're competing with everyone from across Canada.
New York and London are great examples. Look at the brownstones or the flats, where you've got these buildings that have good structural characteristic integrity to them, as far as they might have been around a while, but they're still nice places and they've been renovated. And so you have these flats built in these buildings, or what they call a house, which just means that it goes from the ground to the roof of the building. It doesn't mean that it's not connected to something else.
Right.
And that is more efficient allocation of density than a multiplex, like a fourplex on a single family lot.
Yeah.
So if the cities had their choice, they'd choose row homes over multiplexes. People would probably prefer a row home over a multiplex, but we'll see both get developed. And all of that kind of construction further reduces single family detached home stock, because those are the homes we're demolishing to build that slightly higher density style of housing to create another option to own that's slightly more affordable than a freestanding single-family detached home.
I think the best example for any listener that is familiar with Victoria is Wilson Common. So it's right near the Castle Building Supply in Vic West, and they took down, I think, 3 city lots, and they built 15 of these gorgeous, they look like brownstones. They're not brown, but you get the idea. They're these single kind of stacked homes, and around $1 million, you can get a 3-bedroom place with underground parking.
Yeah.
And they're a really, really great example, I think, of what gentle densification and infill could look like. So aside from developers doing these assemblies, is there anything, I don't know, is there a call to action for, local government listening to this? Is this a provincial issue? Like, if you could send out a message to a listener who is magically listening to the show today that can actually do something about this, what would that message be?
Okay, well, a few different things. So municipalities are strapped, right? For them to cut their costs dramatically, they have the same inflation-driven construction cost issues that developers have. So I think the answer is likely all of the above. If municipalities can continue to or constrain costs from going up further, great. If they can approve gentle densification, different kinds of density, so that we can continue to match supply with demand, which I believe we can going forward now with the temporary resident targets and the population growth targets. We are already generating enough housing starts to meet growth in Canada. We're good on that front.
Great.
It's
Okay.
now just affordability is the problem. And construction costs aren't going down anytime soon. So I would say we need developers to keep doing what they're doing, cities to keep looking for alternatives on density, which is great. And then shared equity or different kinds of financial options for people to start building equity over time. Because as much as rent will keep appreciating with inflation and housing pressure growth, the more families build up equity, they can become the ones that have that capital and don't have to run a mortgage always to fund their home, right? So helping people get more equity so that they don't have to always rely on debt, I see as a big solution, as well as organized housing funds that provide different kinds of financing to pass through that government bond cost rather than the bank's financing rate.
That's such a great idea. It just creates a more stable investment for everyone.
Exactly.
Yeah.
Wow.
Where do we go from here, Adrian?
Where do we go? Honestly, the only thing that I kind of wanted to chat about actually was on our last podcast, we kind of chatted about recent kind of headlines focusing on how 2025 was one of the worst years in real estate in the last 20 years.
Oh, we were going so positive.
No, I
with
know,
this.
but through this podcast and our research, we kind of learned, and this is due to sales volume, right, in BC, and kind of into the headlines as well. But when I dug a bit further, it seemed that actually a lot of the depreciation in these sales numbers came from the Vancouver market, and actually cities like Kelowna, Kamloops, Victoria all had relatively healthy, normal years. Do you have any insight on why you think that might be, that Vancouver really struggled in sales and these, I guess, smaller but desirable other markets in BC had relatively normal years in 2025?
Yeah, I think so. Victoria tends to not be as aggressive in a market with pre-sales. So we tend to not oversupply. I would personally feel like Victoria is one of the safest real estate in the country because we don't have that enhanced or amplified boom bust cycle. Because of how constrained geographically our market is, we tend to not overbuild. We also don't build as quickly and as aggressively as they do in Vancouver. So in Vancouver, when the market's hot, you can see massive buildings go up all in the same moment in time. We don't really get that in Victoria the same way. So we're always kind of struggling to keep up with all the people that want to move to Victoria. And once they get here, they don't leave. So our population's more stable in that way too.
Right. So we're not getting these larger boons, but also not getting the bust,
the drop
either. So we're getting this more of a steadier incline.
And if you look at effective interest rates, it will tend to hit higher priced properties harder because of the distribution of income. So around 80 to 100,000 of household income is kind of between the median and the average. So if you could have afforded a home in that range, either at prior interest rates or at current interest rates, that market is more stable because there's more of those people. That's a much bigger portion of the population at that level. So if you look at the average house price, it's always skewed upwards in the good times by the higher price homes, and the media loves to quote the average instead of the index. And when things come off, interest rates hit the higher price homes, the luxury homes harder, the average will come down because of those top tier homes not selling.
Right.
Whereas the affordable homes didn't swing that much, and nobody's focusing on that stat.
Yeah, that's a good point.
You can really look at that with waterfront listings or anything in kind of Oak Bay. You'll see uplands, pretty crazy price swings when the market's really struggling. But yeah, like a good old single family detached with a basement suite in Tillicum is kind of, that's safe, generally speaking. I don't know, it just doesn't seem to be as exciting, but not as extreme.
I would say people have 18 months to get repositioned in the best house they can buy now or afford now. If they can afford whatever home they can get now.
Oh, there's a sound bite right there.
And then come 2028, we're back to where we were before, where we didn't build enough to keep up with the new demand.
Right.
And the country will be growing, and we'll see. And that I talked about, household formation will start again. And that's it's hard. We're very sensitive to household formation. It's very hard to forecast that. But once that starts again, appreciation comes back.
What is it exactly, or is it a mixture of both? Is it the lack of supply? Is it the population growth, or is it interest rates coming down, or do you think that's like the perfect storm of all three?
All three. So
happening at the same time.
Ontario and BC have had housing starts drop, not dramatically, but drop.
Yep.
And it tends to overcorrect too much. We build too much, we build not enough, right? So will be a lack of a supply at a moment in time, in kind of 2029, I bet, because it takes a couple of years to build bigger buildings. So household formation will kick in when values start to come back up again and rates have fully dropped. Wherever we get to when we know rates are not going down anymore, might be next 6 months or 12 months, we realize, okay, they're not going down anymore.
Oh, it's kind of happening now, I would say.
I mean, when the market's convinced, right?
We
think we're close, but when the market's convinced they're not dropping anymore and values start to creep up, monetary supply growth was up to 10% in 2025. So that will push values up regardless of the supply and demand, just because there'll be more money to fund buying more homes of people, but as it trickles through. But population growth starting again in 2028. We're not going to see population growth until 2028. Household formation and interest rates settling and seeing that appreciation and all that will kick back in again. And we could get to a point where there's too much demand and not enough supply, which is where we were before.
Now, a lot of this conversation, we've been really focused on single family, and I'm with you with that exact prediction. Now, what about condo, maybe also townhouse market? Do you think that's going to lag behind this single family appreciation 2028, like with this prediction? Do you think that stays a year or two beyond that 2028 prediction, or do you think that also swings up at that time as well?
I'd say 2028, 2029, it'll swing up as well, depending on the supply demand. So again, listing sales ratios, that's a good, fairly early leading indicator of trend, because if you see the supply drop relative to the sales volume, the listing sales volume, that kind of tells you where the market is right now based on transaction volumes.
Yep.
But the same forces apply 2028, 2029 beyond with population growth. Condos, unlike single family detached homes that are when we talk about fine art, condos are really driven by construction cost, the total demand at the margin, and financing. So financing gets to the low, we have new demand. Developers aren't going to build more condos unless they can make money doing it, which means the price has to be high enough to cover current construction costs.
Yeah, and
that happens.
Costs are high.
They're high, and they're not going back down. You look at CMHC's costs; they haven't dropped 10%.
Yeah,
right.
So when population demand gets to the point where more condos are needed, they're going to get sold at a price that's high enough to pay for the cost, which will push current inventory values up beyond that, or up to catch up with that as well.
Right. Craziness. Okay. Last question regarding, crystal balls and all that stuff. We're talking, like this is maybe a sure thing in 2028 and it's all great and everything's going to be awesome. But on the other side of things, do you have any sort of biggest risks for housing stability over the next 5 to 10 years that people maybe aren't paying attention to? Or do you think that, that there isn't anything that really that is going to affect the stability?
I would say we've seen there's the black swan risk, right? You can't predict, right? But this risk of people not realizing how much inflation and land constraint can drive the value of housing over time, and not getting into the market or not having a stake in something where they're going to grow their equity based on their home. There's a risk of the values keep going up and people don't get into it, right? They don't get a share of that because they think there's something that's going to happen that's going to go on the downside. What if things keep going up for the next 20 years and you didn't take advantage of that? That is actually a real risk for each person to not get themselves positively exposed to. But I think that the swings are likely going to be continuous changes in immigration policy. As we saw, it was crazy a few years ago. We did homes, and then they completely curtailed that and said, now we're actually going to set temporary resident targets. And what happened? We immediately had enough supply, and the market stopped appreciating.
Yep.
So at the policy level, these swings of just changes of mindset around that policy can drive near-term market.
Right.
But of supply constraints in semi-detached homes, Canada, the World Health Organization, and other international organizations forecast Canada's population is growing some of the highest levels of any of the countries out there because we're so open to immigration. We don't seem to stop it. So between Canada and the US, we're going to grow the most from immigration. Likely, we do not have enough homes for the next 15 to 20 years. We're going to have to keep building more. In BC, we're going to be faced with land supply constraints, and we're going to see home values keep rising. Single-family detached faster than condos because they're not constrained by, or they're not driven by construction costs. They don't have the supply issue, right? And so I think we're going to see home values keep rising. And like I said, $2.5 million average single-family home price in not too distant future. We'll look back and think, I should have bought at $1 million too.
Yep. Okay.
Oh, I mean, people are always kicking themselves about the thing they should have done 20 years ago.
Whether it's in 8 years or whether it's 12 years, like we're not talking about next year, but in Victoria, $2.5 million average single family home price is not impossible at all.
Yep.
It's very likely will happen in the near future or not too distant future.
Okay. I kind of want to get to we've taken a lot of your time, Adam, and I've been sucked into this conversation, but I would like to get into
so engaging, Adam. Yeah, it's really
this has been a good one.
Yeah.
Practical takeaways. So let's focus on buyers for this question. If you're a young household or a first-time home buyer today, what should you be paying more attention to? What should you be doing? And it just sounds like buy a house.
Get off the fence. That's what I'm hearing.
Yeah.
Yeah, I would say, and this is maybe for people to talk about as a family, is parents should truly consider helping their kids. Like, and some parents are like, well, and this goes back to the baby boomer question. Oh, you don't know what I had and what we had to do through in 1982. Not the same. It's not the same. If parents have the ability to help their kids now, they should kind of get off their high horse and how hard it was for them thinking that their kids can save up. Kids can't save up today. It's a very different situation today. So parents should consider whether it's a condo or a single family detached house. If the parents downsize and put the kids into a house, that's better than just the parents keeping the house for a few more years and none of the kids having any houses.
Right.
So that kind of a transaction, I truly believe is probably worth it for the parents, for parents to look at. And then as far as young buyers, I would say good to start somewhere rather than long.
Yeah. Shared equity as an example.
Shared equity or wherever you can. Start the highest up on the ladder you can. If you can buy a house, great. If you can buy a condo, great. If you can buy a townhouse, great. If you can only go something on shared equity, great. Do something to start growing equity.
Yeah.
And don't overdo it. Don't put yourself in a position where you're stressed out and you've got too big a monthly payment. Better start somewhere where it's comfortable, where you can sustain it and keep growing equity for the long term. I think so be tactful about negotiating. Right now it's a good time for buyers. They're not going to get into multiple bid situations likely.
Yeah.
So look for value and try to get into something that's comfortable.
That value out there right now. For policymakers, if you could send one message to policymakers in Canada or BC about affordability, what would that be?
Well, at the highest level, I'll use this last metaphor.
Yeah.
In normal times when we don't have significant deficit spending, the central bank and banking in general creates money supply.
Yeah.
And then when we have deficit spending, significant deficit spending, it's like more money flowing into the system to drive up the value of homes faster than incomes grow. So it's like you have banks and the government putting fish into the ocean, and everybody that already owns a home or owns stocks or a business has a boat with a net. And if anybody that's renting or doesn't own any of those assets is like swimming in the water trying to keep their head above there, trying to catch a fish with their bare hands. Mm-hmm. The banks increasing the money supply through normal banking and the government doing it through deficit spending is going to drive up the value of homes. So from a policy standpoint, I'd say we all have to try to help the government curtail the deficit spending, understand that banking is going to keep creating money supply and keep growing the value of assets. So with credit, so take advantage of that. If you can get cheap credit and get into something, do it because you'll be better off for it. And then in terms of municipal and provincial level, just try to support development, new kinds of density, get in, like everybody, the cities should really push projects to add infrastructure to allow more density as fast as possible.
Yeah.
And at a federal government level, let's really try to keep the immigration targets in the zone of what we can actually build homes for rather than just letting it go wild. Yeah.
Oh, that makes a lot of sense. And lastly, for investors, how should long-term investors rethink housing in a world of higher financing costs and slower appreciation?
And cash flow constraints from rents coming down.
Yeah.
That's another thing that
and maybe
investors are
not
hitting.
slower appreciation. We're talking about $2.5 million homes in Victoria. So any kind of tidbits of info for investors out there.
Okay, so there's a rule of thumb that I truly believe in, which is if you go to a meetup of investors and you hear people talking about what they're trying to do with getting deals together, and you go back 6 months later and you see who was successful, a lot of times it's the ones that were able to partner. being able to partner and be a good partner, right? And knowing how the mindset and the kind of everything works within a partnership and how to manage that and work well with other people.
Yeah.
The key skill for being a real estate investor, because the amount of capital it takes to do projects is so large. Instead of trying to buy a one-off rental, do a sixplex. Go and get MLI Select approved financing for a sixplex, because guess what? You're going to get that cheaper financing. The loan to value is so much higher. So if that takes you working with 2 or 3 other people to do one sixplex, partner instead of trying to do it all on your own.
Yeah.
And go for that source where we know the financing is the cheapest.
Yeah. Okay.
Or bigger, but at least
Yeah.
sixplex, right?
I love that.
Adam, we've kept you here for over an hour. I have a list of a couple fun questions if you have time.
Yeah.
One book, podcast, newsletter, or resource that you'd recommend to someone interested in your sector.
In real estate specifically, or just anything in general?
Or in general. Yeah. Whatever if there's something kind of not in real estate, we'll take it all. Yeah.
Wow, that's a hard question for me because I can think of so many.
Yeah. Well, feel free to list a couple if you'd like.
One book. Okay, well, for those that there's 2 books I'd recommend. One is called Money Capital.
Yeah.
A little esoteric, but for those that really are interested in banking policy and money supply policy, that one is one that is a completely new way of thinking about money supply. And so for those that are interested in that, I would recommend Money Capital. For those that are interested in managing through challenging times, Anti-Fragile is one I've recommended and given away to more people than any other book.
Okay.
Also quite dense, so the audiobook's probably a little easier to start with for those that really want to get into it.
Right.
I think what you guys are doing is great for people that want to actually do something. Like, we talk about all these big ideas, but if you want to actually go and do something, like buy a house, build a 4-plex or a 6-plex or whatever in the local market here in Victoria, this kind of thing is great because you're going to hear about exactly what's happening for a unique strategy in your own neighborhood.
Yep.
So I'd recommend this kind of a podcast for those that can't
thanks,
cover real
Adam.
estate. So,
Wow. Number 2 here. What is a guilty or podcast that you?
Probably. Listening to our Canadian representative on SmartList, Will Arnett, is a good one. The odd random reference to Canadian culture there, that's always fun. Anything else I would say, anyway, I'm from rowing, old habits die hard, still very much into training and getting out in Victoria, riding the bike around, running at Mount Doug, that kind of stuff is definitely a good pastime. So
awesome. What is one purchase you've made in the last year or so under $1,500 that has changed your life?
Wow, these are interesting questions.
Yeah. Getting you thinking a little bit. These real estate ones are easy.
I bought a bass guitar about a year and a half ago, and always been enjoyed music.
Yeah.
A little bit of a hobby. Just pick it up, every few
and have
days
you ever
for a
played
few
before,
minutes.
or was this kind of the
never
first?
played bass guitar
good
before.
for you.
I did play an instrument in high school for a year, but just in terms of understanding music, and I'd say a few minutes a week to something new. I'd also come across some interesting study that showed, and I'll make this comment, that for those of us in work or professions that are fairly analytical or science-based, we kind of sometimes put much emphasis on the creative side of the world, whether it's performing arts or music or painting or whatever it might be. But there's a lot of research that shows that some amount of time to creative endeavors helps the other side as well in coming up with new ideas.
I can definitely see that.
Interesting.
Whether it's music or singing or painting or whatever it might be, that creative outlet can help all of us. So
Okay. And this is a fun one. If you could own any property in BC for free, where would it be and what would it be? And you don't get, this isn't money related, so you never get to sell it. This is ownership.
We're not worried about ROI.
No ROI here.
I've never had, we were on an island, but to have a little island somewhere with a nice view to this, with a bit of a protected little cove that you could jump into the ocean, and that'd be nice.
That is a great answer. That might be mine as well.
There are, you can get, there was one, I'm not even called Little Shell Island, just off of Canoe Cove, and it's like 1.2 million, and it's got a little dock, everything.
That property's going to get sold now in the next week because we talked about it.
No, it's sold.
Oh, we'll check it. Oh, it's sold already.
It's
okay.
sold, but
it's
on my bucket list.
There we go.
Awesome. Adam, before we kind of wrap things up, is there anything we missed that you want to kind of cover, or?
We covered a lot. I mean, we could keep talking, I'm sure, for a long
Well, we can
time
always
about
have
this
you
stuff,
back on.
Yeah,
I think
maybe come back in a year or so and see what's changed.
love
right?
that.
Yeah,
I would love that. Well, Adam, thank you so much for coming today. For anyone that would like to learn, I guess, more about what you're doing or connect with you, Would you like to leave
LinkedIn's
behind
great. Yeah, LinkedIn's great. Just look me up on LinkedIn and message me, and I'll message back. So yeah,
I'll throw that in the show notes. Big thanks to Adam for an amazing conversation. Be sure to follow us at Victoria Real Estate Podcast on Instagram for more behind the scenes, new listings, and local real estate tips. Thanks for listening to Victoria Real Estate Podcast, produced by the CDNS team. We had some fantastic reviews, and we love them. So please leave us a review on Spotify, Apple Music, or wherever you're listening. We also really appreciate you guys sharing the podcast with friends and family. Otherwise, Vince, how do people get in touch?
I like this LinkedIn idea. I'm really
over?
Yeah. Look me up on
anymore?
LinkedIn. I mean, email me too. Vincent at citynest.ca. But let's connect on LinkedIn.
Awesome. And you can reach out to me, Adrian at Adrian Real Estate Victoria, or you can call me at 204-464-4122. And that's a wrap. Thanks, guys.
Thank you.